Hey everybody, welcome. John Bowens here with Equity Trust Company, broadcasting from Miami, Florida at the Grant Cardone 10X studio. I know usually I'm back at home in Cleveland, Ohio at the Equity Trust virtual classroom, but I had to come down here and visit Grant.
It's cold up there, so.
It's freezing. I don't know if I'll make it back.
Yeah.
That's all right. So what I want to do today, Grant, is talk about real estate, of course.
Okay.
So I have been training real estate investors for the last 15 years.
Wow.
I've trained over 60,000 investors, and most of them are real estate. And the questions that I'm getting right now, Grant, and I'm a real estate investor myself. I own residential properties. We make private money loans secured by real estate. And the challenge that we have as investors right now is finding opportunities. So I thought, who better to ask questions about, hey, how do you find opportunities in multifamily real estate? Because I know you're big into multifamily real estate. And for those of you that aren't familiar with Grant Cardone, check him out on YouTube, LinkedIn, various social media platforms. He's got a lot of information out there on real estate, business, entrepreneurship, so you can check that out. He's a best-selling author, so you can check out the 10X rule.
Always with an offer, too.
Right, with an offer.
Always with an offer.
With an offer. 10X rule, I've read that one, great book. The other one
How to create wealth investing in real estate, sell or be sold, be obsessed or be averaged, the closer survival guide. We got probably another 16 business programs that have been purchased by Fortune 1500, top Fortune 1000 companies, Fortune 500 companies.
The be obsessed to be average. One takeaway I took from that is pay the price today to pay any price in the future. So as you know, Grant, I'm very passionate about self-directed IRAs, very passionate about using Roth IRAs and 401ks to invest in real estate, whether it's multifamily real estate or single family residential real estate. I'm an investor myself. And when I talk about paying the price today to pay any price in the future, I'm talking about funding our self-directed retirement plans, right? Putting money in those accounts first. But we'll get to a number of questions. Grant, let's jump right to it. First and foremost, I understand you have, is it $4.1 billion in real estate under management?
Yeah, we have about, adjusted with the market. So we've already adjusted for the market here in 2022. That's pulled back. Our cap rates have gone up, so it'll pull valuations down, even though we're not a seller of anything. We're actually buyers, very aggressive buyers right now, but we're sitting on about 4.1 billion, 12,000 units, 500,000 square feet of office, all cash flow positive. When we buy it, it will cash flow the month after we buy it. We averaged a 6% return cash distribution this year and sent out $50 million to our investors.
So let's talk a little bit more about that. For investors that are concerned about the real estate market. I speak with folks that are brand new, as well as people that have a couple deals under their belt, and they're having trouble finding opportunities.
Right.
So can you speak to, in a very challenging real estate market, obviously we have a number of macroeconomic conditions that are sort of pressuring us right now. Can you speak to how you find opportunities even during the most difficult of times?
Yeah, so number one, you have to be talking to these people that own the assets. Real estate is a who game, not a what game. So it's like, who owns the assets that you want? Now, at the bottom of the food chain, when people are first getting started, they're looking at single family. Single family is not where the opportunities are. There will be opportunities in single family, but the real opportunities in real estate is where you can scale buildings. My first two deals were single family homes. It was easy for me to do. I put 3% or 5% down. I bought the house, flipped it, picked up $3 or $4 grand or 20 grand in one of them. But the real opportunity is where you can scale, and the assets value is based on the rents, not the comps, as you know, of the neighborhood.
Right.
So we're going to become a renter nation. The massive opportunity right now is Jeremy Powell this is going to be the biggest creation of renters in 100 years in America. We're going to go from where we were building homes in the 50s and 60s and building out the middle class. We'll become a renter nation. I believe we'll flip from a 60% home ownership to a 60% renter. That's already true in Houston, Austin, many cities in America. Miami's probably a 60, 55, 45 split, renters to owners, where in most parts of the country it's more owners, as you know.
Right.
So, for retirement accounts, like I had $2 million sitting in a retirement account that I had created over 25 years. It was sitting with Fidelity or Merrill or one of these guys, right? I didn't know what it was invested in. Bunch of funds.
Right.
I pulled all that money out with your help, pulled all that money out and went and directed it to real assets
Mm-hmm.
that provide me with the cash flow, that just goes back to my account, that provided me with the appreciation. These apartment portfolios, typically they'll double every 10 years because of the rents moving up. So we have 12,000 units that our average rent's about $2,000. We think over the next 10 years, those $2,000 rents, regardless of what goes on in the economy, if interest rates stay high, housing can't be bought, which means rents will move up. So if those $2,000 rents go to $4,000, which I think is very, very doable. I mean, you look at 2,000 times 12,000 units, the amount of wealth that's created for people that have money in their retirement account, supported by this real asset that you can see with an address, with rent rolls,
Right.
is just phenomenal.
In my experience in 15 years in the self-directed IRA business, I've seen this transition where years ago, it was the large institutions that had access to what we call alternative investments.
Right,
And when we say
right.
alternative, we're talking about alternative to the traditional markets, the public markets. And then this movement towards alternative investments that Main Street can take advantage of, whether it's real estate in a multifamily type syndication or a REIT, or it could be someone going out and, let's say, buying a single family residential property. I know that you're not a huge proponent of that, but you could do that with the self-directed IRA.
Yeah, 100% you could.
So can you speak a little bit more to that, what that philosophy around working with an individual investor opposed to a large institution?
Well, yeah. So I don't want to deal with the big institutions personally because they're going to put a gun to my head, and they're going to set the rules. Okay. Like I didn't know this when I started the game, but I've had these meetings where, like, Grant, if you put in 100 million, we'll give you $1 billion. That's pretty like it's pretty easy to do. I put in 100 million, a group be like, we'll give you 10 times your money. But that 10 times the money comes with, we're going to tell you when to sell it. We're going to tell you when we want our money back. We want an 8 or 10 or 12% preferred. I can't promise 12% to anybody.
Right.
Like I can't promise that it's going to be out in 3 or 4 years. But see, they want to do that because they're so big, they can be like, hey, you promised us 10. You're not going to get there. Sell the deal. And I don't want to sell. You don't want to get rid of assets. You want to own these assets for long periods of time so that when my retirement account is starting to cash out, not only can I start pulling money out of it, but it also gets replaced with new income from these rental properties.
Right.
I mean, these properties will last, if I can start pulling money out at what, 65?
59 and a half.
59, okay.
Yep.
So these real estate they'll be with me until I'm 99.
Mm-hmm.
Long after this retirement account would have already dumped out, I will still be getting cash flow. So that's how I think about my retirement. I've been putting money in retirement accounts since I was 21 years old.
Mm-hmm. Roth IRAs?
Roth, everything. Roth, SEPs, anything, 401ks, anything and everything that was a way for me to stash $6,000 here, $4,000 here, I did it.
Mm-hmm.
Everywhere I could stash into a retirement account, I would.
Right.
And then when I figured out that I could self-direct it, I became so confident in my real estate because I've never lost any money in real estate. 2008, 2000, 1996 savings debacle. Real estate, income producing real estate is what got me through all those cycles. And even in 2008, 9, and 10, my 2 other businesses got destroyed. My real estate, my rental properties, even though the values went down, the cash flow actually was starting to pop up. So like right now, we have valuations on all real estate going down right now because of what's in the news, because of interest rates exploded, Jeremy Powell and whatever this guy's up to.
Jerome Powell, yep.
Yeah, the Jerome Powell, the devil. And so whatever they're up to, I don't know, but it's crazy because it's going to kill single family home purchases. It already has, lowest in 40 years. Mortgage applications, the lowest in 28 years or something. Mm-hmm. That forces renters. Okay, and it forces more people to rent, and so even though the valuations could come down, the rents will continue to pop up.
Right. I'm glad you brought that up, Grant, because obviously there's a lot of naysayers out there, right? There's a lot of people that are saying, well, that's not necessarily accurate in the sense that we're not going to see rents continue to rise, we're not going to continue to see asset prices rise. How do you react to that type of commentary? I certainly have my own opinions, but certainly very curious to understand, you being a real estate entrepreneur, investor, someone that's out finding opportunities even in very difficult times. How do you react to that type of commentary?
Well, I welcome what Powell's doing, by the way. I'm not a hater. I'm not a hater on it. I'm going to take advantage of it. I know what he's doing. I don't know why he's doing it, but I know what he's doing. I know who it negatively impacts. So I'll buy more apartments this year than I bought in my career. We may double our portfolio in this cycle. So right now we're looking at 5,000 units we would take down if I can figure out how to do it. What's the opportunity? I'm going to pay less than I would have paid 6 months ago. I'm going to be able to buy stuff at cap rates that are 60% higher than they were just a year ago. I'm going to be able to buy distressed assets. That doesn't mean the asset is bad. It means the seller is distressed. All these things I've alluded to, the redemptions, the 3 to 5 year funds, the 8, 9, 10% preferred returns. These things are putting pressure on giants. Okay.
Right.
Everybody, like your assets become your liabilities. This is a quote that I've become a bit famous for, because when you become so big, these big giant names I've been mentioning, they've accumulated tens of thousands of units in the last year. Just in Florida, I know one group that bought 10,000 units in the state of Florida on adjustable money. Okay, they were paying 2.8% on those loans. 10,000 units. Okay, the average one's 250 units. So let's say that's 40 deals. Is that 40 deals? About 40 deals, right? They have adjustable money on 40 different deals that went from 2.8 to 7. Those deals will all be in technical default as we speak.
The theme is, or the thesis here is, finding motivated sellers.
Rather than going and finding one house where a guy's in trouble, because the one house, the single family home is not going to be where the emergencies are this cycle, because he's got an Airbnb guy he can pop in there.
Right.
He's going to put a short-term rental. Short-term rentals did not exist in 2012. There was no Airbnb. The term didn't exist. Short-term rentals weren't a thing. They're here today, and that will resolve all single family home issues. The renter will come in and take care of the note. So, but on the mass scale, when these big institutions bought a lot of units, like that's 10,000 in one state, multiplied times 30 states. Okay, the problem becomes epic. And CNBC's not talking about it. Bloomberg's not. I don't know why they're not talking about it. It's obvious to me. And those guys will have to, you've seen the redemption headlines, and those redemptions will continue to go. And the only way to get to feed the redemptions is to sell the assets.
So where are your apartment buildings located? I understand you have a huge presence in Florida.
Yeah,
That's
Florida, Texas, Arizona, Carolinas. We've been in the Carolinas, Georgia. I love Georgia. I mean, I'll tell you where I like: Utah, Nevada, Colorado, Texas, Alabama, both Carolinas, and Georgia, Florida, anything Florida.
And why those markets?
Because they have job migration. They have companies going there. I mean, Alabama's cheap. It's inexpensive. It's a freaking nice part of the country. The Carolinas, people like living there. A lot of tech companies are moving to the Carolinas. They're moving for Silicon Valley, saying, "Hey, you know what? The thing that we built here is starting to have problems. Urine in the streets. Got homeless problems in Santa Monica, California now. You got New York doing their crazy stuff. People get fed up with it. They're like, enough. And I'm going to go down to Florida, but they stop in the Carolinas. They're like, oh, Raleigh's beautiful. People are discovering parts of America they never imagined. And companies are, look at Twitter. Twitter might move to Miami. They're going to either move to Miami or Texas. Elon moved Tesla out of Silicon Valley. So, when you guys say that rents are too high and they can't go higher, trust me, you have not traveled. You think the rents are high because you look at what the rents did in your market and you missed it. But go to Sydney, Australia, and you'll see high rents. Go to Singapore, you'll see rents that are $9,000, $10,000. Come to Miami and look at one of our buildings that rents for $3,000 a month, and you're like, oh my God, that's so much. Half of the building is from New York. Divorcees from New York that moved down here, and they're like, this would be $12,000 where I used to live. And they got a great swimming pool, and they got a golf course, and they got great weather 9 months of the year. And they don't pay any taxes. That's why these people are coming here.
Right. And then when you actually take down an opportunity, and you move in, you move your team in, obviously. You have new operators in place.
Well, not always. Most of the time we're buying buildings big enough to where we don't have to change the management team. So I have built-in management. I have built-in rent rolls. We have cash flow day one. So when we close in January, we expect cash flow in February. We don't miss a month. We don't develop anything.
Any strategies?
I'm a coward investor.
Okay.
I like cash flow.
Okay. And so is there also a strategy around how you add value?
Yes.
How you increase the NOI on a property?
Yeah.
Can you speak a little bit
to
how that works?
So I have a big brand called 10X. I came from the customer service industry. I worked with Ford and Nissan and furniture companies around the world to improve the customer satisfaction experience so that people felt like they wanted to do business there. And that we teach companies how to make second sales and third sales. That was my start. I happen to be taking that money and putting it in real estate. I've now taken those customer friendly, customer satisfaction centric themes and started to lay them on our real estate. So we put 10X the brand on our portfolio. We have our occupancy is north of 96% across the entire 12,000 units. We have renewal rates in excess of most of the market, if not all of it. We're not a hands-off institution with 200,000 units. We pay attention to the client. We offer our clients, our residents, not our tenants, our residents, which are the tenants. We just talk to them different, treat them different. We even offer them to invest in our properties.
So what I would like to know is, what else do you want to tell the audience here in terms of, what are maybe some action steps that folks can take in terms of, researching this further, understanding more about multifamily real estate investing? I understand that you have a lot of education, a lot of training, all types of opportunities, but what would be a good next step for folks?
I wrote a book called How to Create Wealth Investing in Real Estate. You can buy it at Amazon or you can get it on my site for free. Amazon, I think they charge $30 or something for it. It's cardonecapital.com/free. And you can grab the book there. It basically shows people that want to go do this on their own what the perfect size deal is. 32 units, for instance, 32 units where the rents go up $200 a month. Let me be sure I got my math right here. Every 32 units where you can raise the rents 200, or they naturally, organically are going to raise 200. There's a lot of properties out there that are under, the rents are too low. Some old guy owns them. He's like, I don't want to raise the rents. He bought it in Cleveland 25 years ago. His cost basis is nothing. He's cash flowing so hard. He's like, he can't even spend all this money. He's a perfect target. 32 units where the rents go up $200 makes you $1 million. So if you can raise the rents $50 every quarter on 32 units, every time you can do that, you make $1 million. $50 becomes $1 million in new valuation. And that's what I would tell people to look for. Don't look for the single family that might go up. The better option is to have the scale of the doors to make one close, buy one deal. It is easier to get with a lower credit score even. With a lower credit score, it's more difficult to buy a single family home than it is a 64 unit property, because the 64 units replaces your credit score. Okay, you're actually going to get a better, the lender says, I want to lend it to this LLC right here, not to you. So I have made so much money like this, it's unbelievable. And it doesn't quit making money. And even in bad cycles and tough times like we're going to go through, we're in a recession right now. We're going to have a housing correction. We're having it. It's in play right now. You're not going to be able to get a loan for a while, and you shouldn't. You shouldn't try to do these small loans because rates are too high. They are going to come down. And the biggest opportunity in America today is these big institutional quality 200, 250, 300 unit buildings that are owned by the biggest names in the world.
Outstanding, Grant.